welcome to the FII View with me, Tanvir Gill. The special edition is brought to you from the city of all the action, the city of dreams, New York City, where I am bringing to you the special interview from the Oppenheimer studios. Joining me on this show is Jerry Webman, chief economist of Oppenheimer Funds. He, of course, would make sense of the markets and macros in India and globally. Jerry, thanks very much for taking out the time to speak with us. Really appreciate you joining us today. My first question to you is about the rate cut that has happened in India. We've had 3 in a row, and now the market is nervous about perhaps there being an intermediate pause. How do you react to the policy stance? What's your understanding of what the RBI is doing?
Well, I think the RBI has, as you say, it's lowered rates to something like 7.25%. I think they're in a wait-and-see mode right now. There's a lot of concern about the monsoon, as you know, and what happens to food price inflation. That's a much bigger issue in India. Many of us outside India have to understand that that's a much bigger issue economically and also politically an issue in India than it is in a lot of other places. So I think that the understanding, listening to what Governor Rajan has said, is that for the time being, there is enough monetary stimulus for the economy to grow, but they need to be very cautious on the inflation side.
Yeah, but the RBI has revised growth lower to 7.6%, which means that they are concerned about the upside to growth from these levels, where the potential is being talked about at 8.5%. So if you have to focus on growth, then a faction of the market believes that you need to be more aggressive with rates. Do you think that Governor Rajan's approach there is perhaps one of extra caution towards handling inflation for now and addressing the growth issue but not pushing the pedal a whole lot?
Well, first of all, there's a limit to what monetary policy can do. So there's the transmission that has to occur. Indian banks have a non-performing loan problem. There are a lot of companies that might not actually be able to absorb a lot more credit at this point. So whether much lower rates would really stimulate the economy strongly or not, that's one question. I think the other thing in people's mind is that inflation, in the U.S. we have to look back to the 1970s to get ourselves particularly worried about inflation. India's memory doesn't have to go back quite that far. Rate cuts during, let's say, just to think about the agricultural issue, the droughts of 2002, there's a fear that a rate cut along those lines could lead to a spike in inflation, and that would be very damaging. Inflation is damaging to an economy domestically. It also would be damaging to the rest of the world's confidence in the strength of the resilience of the Indian economy.
But do you think the rate cuts, 3 rate cuts that have come by so far, are enough to stimulate the economy, to support growth?
I think they're enough to support growth. We shall see. There is a fine line to walk. You would rather see growth a little slower and avoid inflation, which will be damaging to growth in the long term. So I'm not going to second guess the RBI on this. I know they've taken a lot of criticism, but I'm not going to second guess them. We know also that monetary policy, in the famous quote of the great American monetarist Milton Friedman, works with long and variable lags. So you've had these 3 rate cuts. We don't really know how they will work through the real economy, and it's probably appropriate to give them some time to work through.
How much time? Because that time is difficult to call in the market.
Of course, it is difficult, and you know that it takes. It actually, the thought is, it can take several quarters for a rate cut to begin to have effect, and there is the issue of well, I'm sure we're going to talk about the U.S. Fed, but you want to make sure that you've protected the currency and rates in India from the potential of a U.S. rise in rates later on this year. So I think it's justifiable to be cautious at this point.
What are your own growth projections for India? Because the government is talking about 8.5% being the potential. And we're closing into that mark. Last reported numbers being closer to 7.5%. Do you think that in an environment where globally, there's a struggle for growth, that India can actually stand out and outperform, in terms of outperforming on the growth front. And where would that growth come from? Would it be largely domestic linked, or would it come in from exports? Because we've been lagging on the export side.
Well, tough question. I don't run an economic model of India independently, so I know what other people have said. I think that the forecast in the kind of 7.5, 7.75 range is a likely intermediate term estimate of India's economic growth potential. You know, over 8%, I think, you know, I don't think there's a person in the world who wouldn't be glad to see that. Yeah. But I think it's quite optimistic. And you know, India does need to grow with domestic demand, and particularly on the investment side. India needs to see both private and public investment step up. Infrastructure is lags. Not that in the U.S. our infrastructure is anything to brag about, as I'm sure you've learned by being here for a few days. But so we're not one to complain, but we both need to invest in it. Yeah. So that needs to happen in India.
And how do you see the investment cycle picking up from here? Because that's again a big debate, like you highlighted, you know. And Governor Rajan has highlighted that too in his speech, saying that, you know, there needs to be enough push to investment and incentive as well for companies to step up on expansion. Yeah. When is that likely to happen? What will be the trigger for that?
Well, it's hard to know, because as we said before, we know that the financial system is, you know, the banks face some challenges. It's hard to extend credit right now. Yeah. And these things, you know, there's a question in many countries, China being the extreme exception, of why have we had as little investment as we've had. We've been slow to have both public and private investment in the U.S. India, the same kind of issue. I think of the reforms we expected to take place over the last year, I think there's some disappointment in the Delhi-Mumbai industrial corridor and how quickly that infrastructure and the infrastructure behind that investments occurred. So we need to see, there are land acquisition issues, there are credit issues. There was you know, many of the infrastructure companies in India obviously are pretty heavily indebted. So
do you think part of the answer lies with pushing public investment first, and then, you know, that would have some sort of a domino effect on, you know, private companies following suit and thereby, you know, stepping up on expansion?
I think both your country and my country need to do something about infrastructure investment from different bases in different ways, and I think that would increase the viability of private investment as well. I mean, you know, this is a much more privatized economy, and we are starting to see some pickup in private investment here without anything happening on the public side. So, you know, I think they have to work in concert.
What about the equity markets? And, you know, the question over there is really about earnings growth, and, you know, how much can that support the rise in the equity markets? Now, we've seen a correction over the last couple of weeks. The markets have been very volatile. You know, as many on the street would read it, you know, there's been some rationalization in the exuberance that the government enjoyed in its first year in office. But do you think that at some point in this financial year there would be a pickup in earnings growth, which have been disappointing so far?
They have been disappointing. It's you know, the percent of GDP that's in corporate earnings is at a very low point in India. So one would think that even with 7.5, 7.75% growth, you would see some pickup in earnings. So I think we'll be hopeful about that. I think investors are going to have to be very selective, though, in finding companies that don't have a leverage problem, that are able to deal with the regulatory and infrastructure challenges that Indian companies still face. So investors in India and among ourselves outside India, we'll have to be very selective to find the companies that can work in that environment.
But how does that translate into valuations for the market, which post-correction are at about 14, 15 times? Do you think that the market is at the lower end of the fair range historically, which means that it's still in the attractive zone?
I think the Indian market is one of the more attractively valued markets in the world. That said, there are probably some companies that deserve to have low valuations, and our job is to find out the ones that you know, where those valuations can improve. There is considerable room for improvement. I think good growth, as we're expecting over the next year, in the services sector particularly, should be valuable.
But that brings me to my next question. You know, this last year, India was one of the best. It was the best performing emerging market. This year, it's at the lower rung. What will change sentiment on India? Because the one question that the street is asking is the trigger that will take the market higher from here.
I don't know if markets ever look for, we commentators look for a trigger. I don't know if markets look for a trigger. I think what will happen is that we will start finding some undervalued companies. Capital will move in those directions. That will start producing, that will cause people to look a little more broadly.
But would that happen now? Would that happen
well, we shall see. I think there is concern now on the reform side. I think international investors, as I read what they say they're doing, are concerned about the slow pace of reform. There were high expectations. I think people are, that non-Indian investors, those of us around the world, will look for some movement on reform, whether it's to see, for example, the goods and services tax move forward, whether to see some more rationalization in the administration. Maybe the license Raj weakens still a little bit more. So we'll look. I think we're going to look for some indication on the economic reform side.
But at a broad level, what's the call in India right now?
I think the call in India is there are some really good companies, but we're cautious on the overall the overall potential of the Indian market. Of
the Indian market. What about the currency then? Because that one has been resilient. It's held out. The intrinsic value of the rupee has been fairly good. Do you think that that would continue, given where forex reserves are at record highs, that India is fairly insulated compared to other emerging markets to an environment if rates do go up in the U.S. end of this year?
Well, here we come back to the RBI again. They have intervened, sometimes aggressively. They've got the reserves to do it. They said they'll defend 75, and I think that most market participants think that that's a defensible level, and that there's reasonable confidence in the rupee right now.
What about the Indian
relative to the dollar? I would say relative to the dollar, it's actually been a pretty good performer relative to everybody else's currency around the world.
Do you think that will continue?
I think it will continue because I think the reserve position, we expect there's going to be some improvement in the current account through the rest of this year. That's everybody's expectation. Good reason to think that does happen. A central bank that will intervene if they need to. So I think that confidence in the rupee is appropriate at this point.
Aside of equities, aside of currencies, the bond market in India, is there interest there, you think, from funds?
I think to some extent. India is one of the higher yielding countries in the world. Sure. I should have done my homework and looked to see what foreign flows in and out of the market have been.
Yeah,
but they've been pretty good. Yeah.
Yes.
So in this kind of 7.5, 7 and 3/4 range on the 10-year bond, I think is a reasonable level. Probably not seeing a big rally from there, but I think that's a reasonable level to maintain global interest.
Talking about global interest, and now the word on the street is that emerging markets have good exposure to India. Emerging market funds, that is, have good exposure to India. But it's really going to be a game changer when global funds start stepping up their investments and take note of India's potential as an investment destination. I mean, in your findings, in your conversations with people, what's the sense that you're getting? Are global funds actually looking at investing in India, perhaps taking this opportunity, this correction, as a means to put in more money in the market? Because that would also mean that different classes of investors are being drawn to the India story.
I can only speak about Oppenheimer Funds and what we've done. Our global investors have always had an interest in India. And we're not, we don't ever think about country overweights, but we've always been able to find companies in India, particularly in the service sector, that make sense, not just for our developing markets, our emerging markets dedicated portfolios, but for our global equity portfolios as well. There's some wonderful companies in India, and we have owned them over time.
When you're saying you're cautious on India, is there, an upside that you are factoring into that view? Are you cautiously optimistic, or you're just cautious?
We're so company by company that I don't think it's fair to generalize about a view of India. We are, I would say, somewhat skeptical about the pace of reform, and therefore will look cautiously at companies that are dependent on major change to move forward.
Let me kind of rephrase that question. From last year, when India was the best performing emerging
Right.
market, how has the view changed?
I think our view hasn't changed very much. I think even a year ago, I think we've understood how difficult the problems of labor market reform, administrative reform, licensing reform, decentralization, tax reform would be in India, and I don't think we ever got enthusiastic, but we're still finding great companies.
And what would make you be cautiously optimistic, or make you optimistic on the market? You highlighted the pace of reforms. That's pretty much the
I think
key?
the pace of reforms. We'll hope to see the agricultural sector do well. We'd love to see the prosperity move more toward the government's expectation than the central bank's expectation. Those were the things we'd be considering. I think that's probably the right way to think about it. I think that in the real economy, I don't think it does very much. Obviously, it changes some things on the margin. It probably affects home ownership. But U.S. corporations have such strong balance sheets now on the whole that they don't need big access to capital for expansion plans. If there's been a slowness in private investment, it's not because interest rates are at any particular level. So I don't think in the real economy 25 basis points matters much at all.
Okay, let's talk about the U.S.
Okay.
And the big highlight there is really, the big question mark actually really is when will the Fed move on rates? And the data that we've got so far suggests that it may not be that the economy is looking very strong, but it's not looking very weak either, which is a tricky point. So what's the view on when the Fed would move on rates?
So let me just first say that I think the big question isn't what the Fed does. The big question is what the U.S. consumer does.
Okay.
And I say that because obviously the Fed is very important to everybody around the world. But let's look at what the Fed is looking at. When they say data dependent, it's not just a catchphrase. They're trying to see if the U.S. economy will accelerate. So what we really need for the U.S. economy to accelerate is for the U.S. consumer to, we've always said that the favorite pastime of the American public is to buy things. Well, we've been a little slow to buy things in recent years. So I think the Fed is going to be watching for some resilience on the consumer side, and therefore use that as a cue to move. To directly answer your question about the Fed, I think the highest, although
because everybody's listening.
Right. Well, the highest, as if I knew. I mean, I can only tell you what they've said. I think they've been very clear about this. The highest probability, but it's probably less than 50% probability, is that they will raise rates by 25 basis points in September. Okay. Higher probability by the end of the year, but
highest
they're
probability.
Yeah, I mean, that's probably, by the end of the year, I think we get over 50% of a likelihood of a interest rate rise.
What about, rates being pushed, the whole discussion of a rate hike being pushed into 2016? What is the probability?
Well, of course, the IMF has recently said they think we should wait till 2016, and I'm sure there's been a discussion why they're saying that and why they're not saying it. It could happen, and that's why I say watch what we U.S. consumers do, how much stuff we buy. So if, for example, the housing market in the U.S. has begun to perk up a little bit, employment remains quite strong. Employment among 25 to 35-year-olds has improved a lot. That's a good thing because that's an age group where if people have a little more money, they might buy a house, they might buy a few things, they might invest. Sure. So we'll watch for some growth in consumption. And
I also want to understand that if, as per expectation, if a rate hike does come in September, would it just be a token rate hike where, they've pretty much given the market what it's expecting and then see how to take things forward in terms of how many hikes and the quantum?
What it's pretty clear they won't do is what they did in the last the 04-06 hiking cycle, which is to say we're going to do 25 basis points at every meeting. You can count on it. You can take a very speculative position in the derivatives market based on it. This is what they're not going to do again. On the other hand, going back to the previous rate cycle to 1994, where we didn't know what they were going to do. They would do 50, 25, skip. So they don't want to be completely unpredictable either. I think they will do an initial rate hike. I think, as we talked about with the RBI, they'll wait to see market reaction and maybe some economic reaction and then judge when the next hikes are to be. But give us some clues, but no promises.
So then what would that rate hike mean for the market? And, just understand your view on how the markets would get into the event and get out of the event, assuming that a rate hike will happen in September.
Well, let's talk about U.S. domestic markets, and then we can think a little bit about globally. U.S. domestic markets have typically, stock markets, have typically traded off a little bit at the time of an initial rate hike, but in fact have gone up from there. So history is that the equity markets do pretty well after a U.S. rate hike. It's only after the hikes have gone, far enough to really slow the economy that it begins to damage the performance of the equity markets. So an initial hike, it might get a little bit of volatility around that time, but I think it's not going to be a negative over months for the.
The other worry with the Fed rate hike is, and I don't know how much ground it has, is what it does for sentiment again when it comes to investments and growth of companies. Is that a realistic assumption or a realistic worry? Because it's at the end of the day it's a 25 basis points hike. How much does it move the needle?
Right. I think that's probably the right way to think about it. I think that in the real economy, I don't think it does very much. Obviously, it changes some things on the margin. It probably affects home ownership. But U.S. corporations have such strong balance sheets now on the whole that they don't need big access to capital for expansion plans. If there's been a slowness in private investment, it's not because interest rates are at any particular level. So I don't think in the real economy 25 basis points matters much at all.
So would you say that it would pretty much be a non-event, given just the anticipation around it? If
I think that's, except, it never is, right? It always feels like it should be, and this is as clearly telegraphed, not just a move, but a understanding around the move, as I can ever remember in the 30-some years I've been in this industry. It's the clearest it's been. But to say, two most dangerous things you can say in this business. One, we all know, it's different this time. The second one is it's already priced in the market.
That's true.
So whenever we assume that, we might well be wrong. So there, as I say, there could be some volatility, particularly because the Fed has used, as other central banks have, not just the overnight lending rate, but a variety of monetary policies, and how those all play together might give some uncertainty in the market when they begin.
My final question is on, you being an investor, where are you finding the opportunity to make money? Where is the alpha opportunity for the second half of this year?
Well, it's always going to be finding great companies that can deal with the adverse situations that we've talked about. I think we're going to find many of those companies in the developing world, in the emerging markets. There'll be some great ones in the U.S., some very good ones in Europe. I think, given valuations, given what the market's done, we may find more of those opportunities in the emerging markets.
But as an asset class, because last year was a great year for equities, this year so far as well, sporadically, region-wise, it's been good. Europe has done well, Germany has done well. Select markets have performed. Between equities and bonds, also perhaps currencies, where is the opportunity?
Between bonds and equities, I would favor equities. We're still in a growth cycle almost everywhere, early, late, middle, but that means equities over bonds. Certainly over government bonds. The more yieldy parts of the markets may be quite fine for people, but generally speaking, equities over government bonds.
All right, Jerry, we'll leave it at that. Thanks very
so
much. Appreciate your time a lot. Thanks very much for this interview.
Gladly.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.